So set a budget, stick within that budget, find something that you can afford for the time being, and you can use the equity that you build up in that home towards a down payment for a future home. Hey everyone, welcome back to my channel. Thank you so much for joining me once again for some more real estate content. So today's video is going to be a little bit of a continuation of the previous video. In the last video, we talked about why houses are so expensive, both fundamentally and different economic factors that contribute to rising house prices over time. But in today's video, we're going to be talking about how you can set yourself up to afford a home, even if you're young, even in a crazy and competitive market. We're going to go through 5 tips that will help you to purchase that home, even in those scenarios. So yeah, let's jump right in. So the first tip I've got for you is to look at first-time homebuyer mortgage options. Now, these mortgage options aren't just for first-time homebuyers, but they're often geared towards new buyers because they have more lenient standards. So you can have a lower credit score in order to qualify. You don't have to put as much money down in order to qualify. So it's usually a little bit easier for first-time homebuyers to finance a home purchase through a first-time homebuyer mortgage option. 3 well-known loans in this category are the FHA loan, the VA loan, and the USDA loan. The VA loan is a Veterans Affairs loan. It's a zero-down loan with no credit score requirement, but you're only eligible if you are active duty military or a veteran. So if that's you, absolutely take advantage of the VA loan. The USDA loan is a low-interest, zero-down loan with a credit score requirement of, I believe, 640. If I'm mistaken, I will put the correction up on the screen here. But you are only eligible if you live in rural areas. So according to the USDA, rural areas are defined as open country, which is not part of an urban area, and there are also population requirements that can reach up to 35,000 depending on area designation. So if you're purchasing a home in a rural area, definitely look into the USDA loan. Now, for most of us, we don't necessarily fall into the categories for the VA or the USDA loan, so that leaves us with the FHA loan, which is a fantastic loan option if you are a first-time home buyer. This loan is backed by the Federal Housing Administration, which means that it is insured by the government. Because it is insured by the government, there are, again, more lenient standards, so you can have a lower credit score and you can put less money down in order to qualify to finance a home through this particular loan. So for the FHA loan, you generally have to put 3.5% down, which is typically pretty manageable when compared to 10 or 20% down with a conventional loan, and you can have a credit score of 580 to qualify. Different lenders may have different standards. It could still be an FHA loan, but a lender could say that 580 is too low of a credit score and they might want you to have a higher credit score in order to finance with their specific bank or credit union. But generally 580 is the credit score that you can have in order to qualify for the FHA loan. Those with a credit score between 500 and 579 can still qualify for an FHA loan, but you would have to put more money down. Instead of 3.5% down, you'd have to put 10% down. When I first heard about this loan, my brain immediately went to, okay, what's the catch? It sounds like a great opportunity. You get to put less money down, you can have a lower credit score, but there's gotta be a catch somewhere, right? So we're gonna talk about a few of the cons with the FHA loan. They're not necessarily cons, it's not a bad thing. It's just something that you have to consider when you're financing with an FHA loan. So the first thing to consider is that you will have higher total mortgage insurance costs. When you're financing a purchase through an FHA loan, you will have higher mortgage insurance costs because this is a loan that allows more lenient standards. So they really want to make sure that they are insured in case you default on your loan. With FHA, you will pay a monthly FHA mortgage insurance premium and upfront mortgage insurance premium of 1.75%. The only way that you can eliminate this insurance is by putting 20% down on the home or canceling the insurance after you've built 20% equity in your home. You can also start out with an FHA loan and then refinance to a conventional loan later on down the line. So there's your first catch. You're paying higher monthly mortgage insurance premiums with an FHA loan. The second catch is that the house has to be structurally sound and in really good condition. Maybe not really good condition, but in good condition in order for the bank to finance through an FHA loan. Super hardcore fixer-uppers are generally not a good idea to finance through FHA loans. And the reason being is that the bank, the lender, your credit union, they want to make sure that the house is good enough collateral in case you default on your loan. So they're loaning you all this money. You have maybe a little bit of a lower credit score, so you're considered more of a risky buyer, and they want to make sure that the house is nice enough so that if you default on your payments, if you stop paying for any reason, the house is nice enough in order for them to be able to take the house and recoup their losses. If the house isn't really all that nice, if it's not in good condition, if it's not in livable condition, it's not good enough collateral, they can't take that house and recoup their losses because it's just not in livable condition. So they will want the house to be in good condition in order to finance through an FHA loan. That doesn't mean that you can't get a fixer-upper with FHA. It just means that it might be a little bit more difficult to get a fixer-upper to qualify for an FHA loan. So if you have a little bit of a picky appraiser, it might be a little bit difficult. So there's your second downside, another thing to think about when financing through FHA. Another thing to think about when financing through FHA is that this type of loan is only for primary residences. So you have to live in that home for at least 12 months in order to be able to finance through FHA. You can always live in that home for 12 months, then move out and rent it out, do whatever else that you want to do with it, but you have to initially live in the home for 12 months to be able to finance through an FHA loan. The final thing to consider when financing through FHA is that there is a limit on the amount that you can borrow. This limit is set every year depending on what state and county you live in. Generally, the limit is about 65% of a county's conforming loan limits. Now, a conforming loan is a loan that has limits set by government enterprises, so there's a limit on how much you can borrow with the conforming loan. So you'd have to ask your lender what the conforming loan limit is for the county that you live in, and from there you'll be able to determine how much you can finance through an FHA loan. The second tip I have for you is to tackle your debt before purchasing a home. The reason I say this is because lenders look at your debt to income ratio when they're determining how much you qualify when you're trying to finance a home purchase. If your debt really surpasses your income, they're going to view you as a risky buyer. Your interest rate on your loan might be higher, you might have different standards than a person with a lower debt to income ratio would, and so in order to really ensure that you're getting the best deal on your mortgage, it's better to make a good dent in your debt. If you can't get rid of it completely, at least really work on it to get your debt to income ratio a little bit lower so that your loan standards are much better and your interest rate is lower when you're going to apply for a loan. Now, I know this is much easier said than done. It might take a few years in order to really get debt under control or to eliminate it completely, but it's better to make a good dent in your debt before trying to apply for a loan, because again, that will ensure that you have a really great mortgage, that you have a great interest rate, you're getting a good deal. If you have a higher debt to income ratio, again, they're going to view you as a risky buyer and your loan terms might be less than ideal. Now, speaking of debt, when you are in the process of already buying a home, when you're applying for a loan, when you're getting your financing under control, don't buy a new car and don't open up any new credit cards. This will greatly affect your credit score, which will affect the amount of money that your lender is willing to loan to you. So don't buy that new car. Wait until after you're settled in your new home, until you have closed on the house and everything is under control, everything is settled, until you try and open up new cards or buy a new car. It's better to wait after you've already gotten that loan. Now, the third tip I have for you is don't try and spring for your ideal home right off the bat. A lot of people already know this. I'm sure this isn't news to anybody, but I really wanted to reiterate that when you're buying your first home, it's likely not going to be that dream, custom, perfect home you've always dreamed of. It's going to be something that you have to more or less settle for. So set a budget, stick within that budget, find something that you can afford for the time being, and you can use the equity that you build up in that home towards a down payment for a future home. For those that don't know, equity is just a term that describes the difference between the market value of your home and the amount that you owe to the lender who holds the mortgage. So put simply, it's the amount of money that you would receive after selling your home and paying off that mortgage. So here's a quick example. You buy a house for $250,000 with a down payment of $50,000 and a mortgage for the remaining $200,000. Your initial home equity is the same as your down payment, just that $50,000 that you put down. Over the years, you pay down $30,000 of principal on your mortgage debt, so now you owe $170,000. During the same period, the market value of the home has increased to $300,000. Again, we talked in the last video about how house prices go up over time, so it's likely that your house will go up in price over the years, so it's better to purchase a home that you can afford for the time being to build that equity, and then use that equity for a future down payment. But let's continue on with our example. So your home equity is now $130,000. The difference between that $300,000 that the house is now worth and what you owe on it, which is $170,000. So building up equity is something that is so important and so amazing. So when you're in a home that you can afford, the mortgage payment is manageable for you, the home is going up in value over time, and then you can use that equity to purchase the home that you've always dreamed of in the future. So there's tip number 3. Don't spring for your ideal home right off the bat. Build equity in a starter home to use for a future down payment for a home that you love even more. Now, the 4th tip that I have for you is to consider purchasing a fixer-upper and renovating it and financing all of that through a hard money loan. Now, when a house is not in what the bank deems as livable condition, they're not going to want to finance that purchase. They're not going to want to give you a loan to purchase that home. And the reason being, we talked about this earlier, is that the house is not really worth much, so it's not good enough collateral in case you default on your payments. So if that's the case for you, you might consider purchasing a home through a hard money lender. A hard money lender is an individual or a business that is separate from banks or credit unions. Now, this lender, this investor, typically isn't interested in your credit score or your income. They're more interested in the equity on the property and potential return on their investment. Because these investors are lending on riskier properties, on properties that really aren't worth much at the time of purchase, they typically charge higher interest rates in order for you to be able to borrow their money. So these loans are better for a short period of time. If you're purchasing that fixer-upper, you need cash right away, and you want to be able to renovate the house. The hard money loan is typically only good for that period of time while you're renovating, while you need to make that purchase and the bank doesn't want to finance it. And then once you've renovated, you've gotten the house appraised, you can then refinance to a conventional loan, which typically has a lower interest rate. If you do default on the loan, the investor would simply take that property and sell it to try and recoup their losses. Now, of course, there's so much more to consider when talking about hard money loans and investors, but this is just a brief overview. When considering how to find an investor or a hard money lender, you can do so by simply Googling hard money investors in your area, wherever you live, the city and the state that you live in, and trying to find an investor that way. But of course, you have to be able to make sure that they have a good reputation. Check their reviews, talk to past clients to see if they enjoyed their experience with that investor. Check and see if they're able to get you the funds fairly quickly. If it takes them more than a week to 2 weeks to get you the funds, that would be a red flag. So again, to summarize, this strategy would be great if you're trying to purchase a fixer-upper, like a really hardcore fixer-upper. You need cash right away, the bank doesn't want to finance it, and you use that money while you're renovating the home, and then you refinance to a conventional loan after you're done renovating. Alright, you guys, we're going to finish out this video at home. I took a little bit longer than I normally do at the office, and people started to come in, and because I usually kind of use the whole space and spread out, I decided to come home and finish it out here at home. So tip number 5 is to consider buying multifamily instead of single family. Now, multifamily is any property that has more than one unit, so like a duplex, triplex, fourplex, whatever that may be. And the reason that you may consider purchasing multifamily is because you can live in one of the units and rent out the others. The rent that's coming in from those other units has the potential to, if not completely pay for your monthly mortgage payment, then at least partially cover it, so you're paying a very small amount. Now, of course, the rate of return is going to depend on what multifamily property you purchase. So if you purchase a larger property with more units that you can rent out, you may be making more money. You may even cash flow and make more than what your monthly mortgage payment is. But if your goal is simply to have a good portion of your monthly mortgage payment covered by rent coming in from 1 or 2 other units, then something like a duplex might be the better option for you. Essentially, the point is to delegate out those payments to other people, to tenants that are renting out your other units, so that you are having to pay less monthly for your mortgage. Now, there is a lot to unpack in terms of house hacking, so if you'd be interested in a more in-depth video on this in the future, where I talk about numbers from seasoned investors and how they've cash flowed from their different multifamily properties, I would be more than happy to do that. I don't have any personal numbers to share because I haven't tried this strategy in my own life, but I'd be happy to talk more about this in a future video if you're interested. So there are my 5 tips for purchasing a home, being able to afford a home, even if you're a first-time home buyer, even if you're young and it's a crazy market. These 5 tips should be able to help you find a strategy that works for you and purchase a home, become a homeowner, and start building equity even if you're young. I've got some quick additional tips that I wanted to share with you. The first one is to start saving early as possible. You're never too young to start saving for a down payment for your future home. Set a budget and stick to it. We talked about this in one of our tips today, but this is so important to really make sure you know what your budget is so that you are looking for homes within that range. Strengthen your credit score. Open up a credit card as soon as you're able to do so. Even if you're a teenager, it's really important to start building credit as early as possible. Pay your bills in full, pay them on time. Don't use your full limit. So if you're a teenager and your limit is something like $250, don't spend that full $250 every month. Only spend a portion of that and make sure you're paying it in full and on time every month. And keep all of your credit cards open. So especially when you're looking to finance a home purchase, don't close any credit cards. Even if you aren't using them, you can continue to not use them. It's just better not to close them because that does affect your credit score. Shop around for different lenders. Compare origination fees and interest rates because those do differ depending on the lender that you go to. So make sure that you're getting the best deal possible. Get pre-approved as soon as you're ready to start house hunting. In a competitive market, sellers are not going to wait for you to get pre-approved. They're going to want you to already have that done before they accept your offer. So as soon as you're ready, make sure you go to a lender and get pre-approved. Tour homes. Make sure you're going to open houses. Ask your realtor to take you to showings. Actually seeing a home in person is so much more valuable than just looking at pictures on Zillow or Trulia. Don't skip inspections. You're not going to want to deal with costly repairs or renovations unless you're specifically looking for a fixer-upper. And if you do decide to skip the inspection, at least get a home warranty so that you're covered in case you have to pay for any renovations. And finally, work with a realtor. They negotiate on your behalf. They market on your behalf. They do so much for you. They can provide so much value. And if you're ever curious as to the value that a realtor can provide for you, reach out to your realtor or reach out to me and I can tell you exactly what I'm going to do for you, whether you're a seller or a buyer. Realtors provide a lot of value. All right, you guys, thank you so much for joining me for today's video. I'm so glad that you chose to spend your time with me today. Please consider liking and subscribing if you found this video helpful or beneficial in any way. It helps me out so much. And make sure that you turn on the bell notification so that you get notified every time I upload. Make sure to follow me on Instagram, which is @ArenaD, and on TikTok, which is @ArenaDPDXRealty. I post a lot of real estate content on there, a lot of tips, so if you want to be a part of my journey, definitely follow me on there. Again, leave me a comment if you're curious to see a video diving into house hacking, or if there's a video on a different topic that you're really interested in, leave me a comment and let me know so I can make that for you. All right, you guys, thanks again for watching. I'll see you next week. Bye!